one story in town and what Ben Bernanke is going to say. Are investors right to be nervous?
They're not really, actually. What he's going to say, and he's going to try and calm people down, is to say, look, we're all grown up now. We've got enough growth. We can take the stabilizers off the bicycle that he's provided us. We're all big boys and girls, and we can do without quantitative easing and asset purchasing. And what he's going to do, the way he's going to do it, is he's going to focus on hope of growth, just to ease us off that little sort of baby's dummy that we've got used to of QE.
Now, China, we're also watching China closely because of, talk of extra monetary stimulus there and perhaps the credit bubble bursting. Are you concerned by all this talk?
No, and isn't it coincidental that just as the Americans are talking about easing off on monetary policy, the Chinese are stepping up, and of course they're both meeting at the Q8. I'm not a conspiracy theorist, but the timing is perfect. The Chinese have got to be concerned about inflation because you see what's happening in Brazil. Too high rises in prices and you're going to get social unrest, and the Chinese don't want that above all else. So it is interesting that they're thinking about monetary easing and lowering interest rates, and that's a good boost to emerging markets, just as the emerging markets get concerned that the Americans might stop asset price purchasing.
And of course, speaking of emerging markets, we've seen the demonstrations in Brazil after Turkey. Should emerging market investors be worried about all this unrest, or is it to be expected?
Well, there's two things. One is the investors. Now, you look at any long-term chart of growth of a country in terms of GDP, and it directly correlates to the market capitalization of its stock market. So over 5 to 10 years, of course, we're going to have to be in emerging markets. Over a 12-month period, 24-month period, all these politicians are going to get the votes based upon selling you hope of greater wealth. And of course, when they can't deliver, you get 200,000 people in Brasilia, as you saw over the last 48 hours, protesting, because sooner or later we get tired of all their promises. That's all that's happening. It's short-term volatility, but longer term, you've got to go with the countries with the greatest growth rates, and those are going to be, of course, countries like Brazil, China, India.
And let's come back to Germany, because we also had a big data point from Germany today, the ZEW showing a slight uptick. But at the same time, the Bundesbank is talking of potentially a slowdown in the second half. Which side are you on?
I'm definitely on the side of growth, and the reason I'm on the side of growth regarding Europe as a whole is, first of all, the Germans have got through this magnificently well, this whole European debt crisis, but also just look at the fact that that is the world's largest trading zone. You're looking at a $16 trillion economy in the EU, even if you get no growth at all, and there's only one direction left to go. Given that we've gone through all the debt crisis, the only direction left is going to be upwards, because we've got through the worst of it.